Hello, Rick Komarek, Certified Financial Planner, sharing with you an article I uploaded to my blog a couple days ago titled The Approaching Light Before the Dawn. Let's dive right into it and take a look. Let's take a moment to briefly outline the situation looking at the hard data. The unemployment rate soared to a post-depression high of 14.7% in April, while the survey of business is by the U.S. Bureau of Labor Statistics revealed a loss of 20.5 million jobs in April, the worst monthly reading since records began in 1939. In a single month, nearly all the jobs created after the financial crisis disappeared, at least temporarily. April's 11.2% drop in industrial production, a metric the Federal Reserve has tracked since 1919, is the biggest monthly decline on record. Furthermore, consumer spending in April fell 13.66%, the biggest decline ever recorded, U.S. Bureau of Economic Activity. Record layoffs continue, with the number of first-time claims for unemployment insurance topping 40 million over a 10-week period ending May 23rd. Put another way, nearly 1 in 4 working Americans have experienced a job loss. If there is any good news, it is that the number of first-time filings have been declining, and the number of individuals who file on a regular basis in order to receive jobless benefits is about half the number of first-time filings. This would suggest that paycheck protection loans are kicking in and reopenings are encouraging businesses to recall furloughed workers. Still, May's employment report will likely show another rise in the jobless rate. Let's back up for a moment. In April, I noted in just a 3-week period, the number of first-time claims for jobless benefits totaled an astounding 17 million. For perspective, during the 18-month-long 2007 to 2009 recession, first-time claims totaled 9.6 million. Yet the Dow Jones Industrial Average added 2,107 points over the 3 Thursdays the massive number of new claims were released, according to St. Louis Fed. Since then, April 9th, the Dow has added 1,664 points, or 7%. It's up 36.5% since its near-term March 23 bottom. The broader-based S&P 500 index eclipsed 3,000 by the end of May and has rebounded 36.1% from its March 23 low. Meanwhile, the tech-heavy NASDAQ composite has added 38.3%, is back above 9,000, and is nearing its all-time high. Simply put, economic activity is falling with depression-like speed, but the major averages are in the midst of an impressive rally. Here's one more piece of performance data. During the financial crisis, the S&P 500 index lost nearly 57% from its October 07 peak to the bottom in March of 09. This year, in about 1 month, the S&P 500 index shed 34% before hitting a near-term bottom on March 2023. The adage, stocks climb a wall of worry, has never been more appropriate amid economic devastation and an outlook that remains incredibly murky. A closer look at Wall Street, Main Street disconnect, a combination of factors has fueled the rally since late March. The response by the Federal Reserve has far outpaced its 08 response, which has lent a tremendous amount of support to stocks. The same can be said of government fiscal stimulus. Investors are also keeping close tabs on state reopenings, which will reemploy furloughed workers, help stabilize the economy, and set the stage for a possible economic rebound later in the summer. Talk of vaccines has also helped. You see, investors don't simply look at today's data, which in many cases is backward-looking. Instead, they are forward-looking as they attempt to price in economic activity, the level of interest rates, corporate profits, and more over the next 6 to 12 months. And approaching dawn, if we look at what is called high-frequency economic data, daily or weekly reports, we are beginning to see signs of stability. Daily gasoline usage has rebounded. Daily travel through TSA checkpoints is up. Hotel occupancy is up off the bottom. And the same can be said of weekly box office receipts. In addition, the weekly U.S. MBA Purchase Index registered its 5th best reading over the last period here, suggesting that low interest rates and some confidence that the U.S. economy is set to recover are lending support to housing. Of course, these are highly unconventional measures of economic activity and are industry specific. Outside the purchase index, each remains well below its previous high, but the turnaround suggests we may be seeing some light at the end of this very dark tunnel. Collective wisdom. Any given level of a major stock market index represents the collective wisdom of tens of millions of stock market investors. It's not simply an opinion, it's an opinion with money behind it. When stocks were in a free fall in March, investors were anticipating a devastating blow to the economy. Tragically, the data did not disappoint. Has the rally been too much too quickly? Even in the best of times, economic forecasting can be difficult. Today, the outlook is clouded, with a much greater degree of uncertainty. Will the virus lay down over the summer? How will reopenings proceed? How quickly can a readily available vaccine and treatment be developed? What might happen to COVID-19 in the fall and winter? How quickly will consumers venture back in public and resume prior spending patterns? These difficult questions, are hard to answer. Don't expect a return to pre-COVID jobless rate anytime soon, but investors are betting that an economic bottom is in sight. I understand the uncertainty facing all of us. We are grappling with an economic and health crisis, not to mention recent civil unrest. We've addressed various issues, and I have an open door policy. If you have any questions, concerns whatsoever, let's have a conversation. That's what I'm here for as your trusted financial planner. Take care.